In 2025, international stocks did something that we haven't seen in a while. They didn't just perform well, but they left the US market in the dust. The international market, which is the MSCI All-Country World ex-USA Index, had gained 29%, almost doubling the returns of the S&P 500 at around 16%. And in this video, I'm covering 7 of the best international ETFs to invest in, each with their own unique strategies to help you improve your diversification and growth potential. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. But before jumping into the ETFs, let's talk about why international ETFs are even worth looking into. So even after international stocks had a huge run-up last year, they still trade at a 20% or so discount to US stocks when looking at forward PE ratios. This just means that today, international stocks are still trading for cheaper prices than US stocks. Next would be the US dollar, which since 2025 has dropped nearly 10%, and last year was one of the worst years for the dollar since 2017. When the dollar is weaker, foreign currencies are stronger, and it increases the value of international stocks and foreign currency investments when you convert them back to dollars. This, along with cheaper valuations and growing earnings, are big tailwinds for international ETFs and the international market as a whole. Another important consideration is that no single industry, sector, or even market leads the way forever. The 1970s, 80s, and early 2000s were decades that the international market really stood out from the US. This is all to say that cycles come and go, and today the changing macro environment and cheap valuations could make the case for a change in the narrative. And this brings me to the main point: what exactly does this mean for your portfolio? Since the US market is not always in sync with other markets, adding international ETFs can improve diversification, lower volatility, and add some cushion to your portfolio if domestic markets are hurting. With that being said, now let's get into the international ETFs. First, we have IDMO, the Invesco S&P International Developed Momentum ETF. This fund tracks the S&P World ex-US Momentum Index, which is the index that selects international stocks with high momentum values. How this works is it looks at the performance of stocks over the last 12 months, along with a few other metrics, and it gives the stocks a momentum score. Then it chooses the top 20% of stocks by their momentum score for its portfolio. This momentum strategy assumes that stocks that are performing well recently are likely to continue doing so in the near term. For the portfolio, IDMO has 192 holdings, with its top holdings in names like HSBC, Toronto Dominion Bank, Siemens Energy, Rolls-Royce, Mitsubishi, and more that make up about a quarter of the portfolio. The sectors the fund is exposed to are financials, which make up over 40%, then industrials, and materials, which make up the majority here. IDMO has an expense ratio of 0.25%, costing you $25 yearly for every $10,000 invested, which isn't too bad. And for the dividends, it comes with a dividend yield of 3.5%, which is going to be paid out quarterly. Now, I did mention international stocks have been doing well recently, where IDMO has had a 1-year return of 31.6%, 5-year annual returns of 15.4%, and annual returns over the last 10 years of 12.2%. I think the strength in a momentum fund is pretty clear. When international stocks are on a bull run, IDMO is going to be taking off. And whatever stocks are leading the way, IDMO is going to have exposure to, which for now is in financials and materials. But be sure to keep in mind that this strategy depends on momentum and recent performance of stocks, so it will struggle during periods of slowdowns, contractions, or recessions. IDMO is for those investors that believe that the international market has a lot more room to run and they want to hold the leaders of the pack, while also getting that additional exposure to international stocks. Coming in at number 2 is SCHF, the Schwab International Equity ETF. This ETF tracks the FTSE-developed ex-US index, which covers large and mid-cap international stocks. And this is across 24 developed markets outside of the United States, which is made up of roughly 85% large cap and 15% mid-cap companies. You could think of this as a simple and straightforward way to be exposed to international and developed markets. Currently, this fund has around 1,505 holdings, and the top names include Samsung, ASML, SK Hynix, HSBC, Roche, Novartis, and more, with exposure to sectors like financials, industrials, technology, and a few other sectors. And you can see just how diversified this fund is, not just in the amount of holdings that it has, but also in its sectors and country exposure. SHF is low in the fees with an expense ratio of 0.03%, costing you $3 for every $10,000 invested. And it comes with a pretty nice dividend yield of 3.1%, and that's paid out every 6 months. For the performance, SHF has had a 1-year return of 34%, 5-year annual returns of 9.9%, and annual returns over the last 10 years of 9.8%. Consistent and steady, which is exactly what you'd want to see for a broad-based international fund. Since SHF is a broad international fund, it's not concentrated in just one single area, and instead it gives you exposure to a wide variety of holdings and sectors. Even though it's developed market focused, that's over 24 countries and well over 1,000 companies, making it a solid core holding. One thing to keep in mind though is since it's focused only on developed markets, it's not giving you exposure to emerging markets. But it still makes a great core holding for international exposure with low fees, diversification, and a history of some decent returns. Moving on, we have AVIV, the Advantis International Large Cap Value ETF. Unlike the previous ETFs, this ETF is actively managed. The management team invests in international large cap companies that are trading at low valuations with higher profitability ratios. So the combination of value and profitability are key in its stock selection. The portfolio of AVIV has about 611 holdings, and some of the top names include Shell, BBVA, Roche, Rolls-Royce, and HSBC. On the sector side, financials is up top, then industrials, energy, and materials. This makes the portfolio lean more towards value-oriented and cyclical areas of the market. For the fees, AVIV has an expense ratio of 0.25%, costing you $25 per $10,000 invested. And the dividend yield is currently sitting at 2.8%, which is going to be paid quarterly. Since AVIV was created in September 2021, it doesn't have a long history, but so far it's done pretty well. With a 1-year return of 38.2%, a 3-year annual return of 20.8%, and annual returns of over 13.5% since it was created. For a fund that's less than 5 years old, it's made a strong case for itself. AVIV's strength really comes from its strategy. Rather than just buying cheap value stocks, the strategy avoids the value traps and buys undervalued stocks with quality earnings and solid fundamentals. But something to consider is that the fund doesn't have a long track record, so it hasn't been tested through a wide variety of different market conditions. It also has a slightly higher fee, but in reality, it isn't that high for actively managed fund. But AVIV has a solid approach to international value investing that goes well beyond just picking cheap stocks. And this fund is for those investors that want to expand their portfolio to have exposure to quality filtered international value stocks. This next one is very different, and that's frdm, the Freedom 100 Emerging Markets ETF. This has to be one of the most unique ETFs on the list, and it tracks the Life plus Liberty Freedom 100 Emerging Markets Index. The index ranks emerging market countries not on market cap, but instead on the basis of personal, economic, and political freedom, and using 87 quantitative variables to measure each country's level of protection for personal and economic freedom. Each country then gets a freedom score, and that determines how much weight it has in the fund. And companies that have 20% or more of state ownership are going to be excluded. And the top 10 companies in each of the countries are selected and weighted by market cap. This creates a portfolio that has around 136 holdings, with top holdings in companies like Samsung, Taiwan Semiconductor, SK Hynix, LATAM Airlines, and more. While the sector exposure includes technology, which makes up a big chunk, then financials, industrials, and a few others. You can see from its top holdings it's pretty heavily tilted in tech, and more so specifically exposed to the AI chip supply chain. This fund is on the higher end of fees with an expense ratio of 0.49%, and it has a dividend yield of 1.7% that's also going to be paid quarterly. Now for performance, you might be shocked by this one, but Freedom has had a 1-year return of over 78.5%, a 5-year annual return of 16%, and an annual return of 16.8% since it was created in May 2019. And these returns aren't random. That's really thanks to the exposure to the semiconductor companies from Taiwan and South Korea. But what really makes Freedom stand out is its unique strategy. It's a different take on emerging market exposure with its freedom weighting and it also doesn't have heavy exposure to China. In reality, it doesn't have any at all, like other emerging market funds. But this, of course, means this fund will underperform normal emerging market ETFs when China or other excluded markets are doing well. The Freedom strategy will also make the portfolio more concentrated in a select few countries than a typical emerging market fund, so that's just something else to keep in mind. And if you're an investor that likes this approach and strategy to emerging markets, along with the growth potential that it could provide, this is an international fund to look more into. Number 5 is going to be vxus, the Vanguard Total International Stock ETF. This fund tracks the FTSE Global All Cap ex-US Index, which invests in both developed and emerging markets outside of the US. This includes small, mid, and large cap companies, so you're essentially getting the whole entire world beyond the US in just this one single fund. This is why the portfolio of VXUS has 8,794 holdings, making it one of the broadest international funds. And its top holdings include names like Taiwan Semiconductor, Samsung, ASML, Tencent Holdings, and SK Hynix. And for the sectors, you'll find financials, industrials, and technology making up the majority of the exposure, but it still has a nice well-rounded mix of exposure to other sectors. And if we look at the country exposure, there's a nice spread across different countries like Japan, the UK, Canada, China, Taiwan, and many others. VXUS is low in the fees with an expense ratio of 0.05%, costing $5 per $10,000 invested. And the dividend yield comes in at 2.7%, which is paid out quarterly. Moving to the performance, VXUS has had a 1-year return of 34.4%, a 5-year annual return of 8.6%, and annual returns of 9.3% in the past decade. Decent and steady returns is what you'd hope to expect from a broad fund of this size. What makes this fund stand out the most is the fact that you're nearly getting 8,800 stocks spread across the world. That's small, mid, and large cap stocks along with developed and emerging markets all in one, making this fund a simple approach to getting maximum international exposure. Something to consider with VXUS compared to a developed market fund like schf is that emerging market exposure. This makes up about a quarter of the portfolio of VXUS, and emerging markets can come with more volatility in currency, geopolitics, regulations, and more. Now, this isn't a reason to avoid the fund, but just highlighting a key difference. VXUS is the most complete international fund in this list, and if you're looking to invest in a fund with the most international diversification and low fees, then look no further. This next fund is idvo, the Amplify CWP International Enhanced Dividend Income ETF. This is an actively managed fund and it's pretty unique from the others in how it operates. This fund invests in international large and mid-cap companies for the MSCI ACWI ex-USA Index, and it aims to provide income from international dividend-paying stocks and by writing covered calls on stocks in his portfolio. The management team selects stocks that are then screened based on earnings, cash flow, return on equity, and other metrics. And it uses a tactical covered call strategy on individual stocks, and it writes call options on around 30 to 60% of the total portfolio. And idvo aims to generate annual income of around 2 to 4% from the option premiums and 3 to 4% from the dividend income of its holdings. And idvo's portfolio currently contains 76 holdings in total, with its top holdings in names like Taiwan Semiconductor, Nutrien, Alibaba, Cameco, Siemens, and more, with the sector exposure being in financials, materials, energy, and industrials. So a nice mix of exposure here that leans more into the cyclical sectors of the global market. For the cost, idvo has an expense ratio of 0.65%, which is a little bit high, but keep in mind it's an actively managed fund. And idvo is impressive when it comes to the dividends, with a dividend yield of 5.4%, which is paid out every single month, unlike a majority of the funds here that are paying quarterly. That high yield is thanks to the combination of those stock dividends and option premiums. idvo was created in September 2022, so it's had a short but solid history when it comes to performance, where in the last year it had returns of around 41.5%, 3-year annual returns of nearly 24%, and annual returns of 25.8% since it was created almost 4 years ago. So some really amazing returns for an international income-focused fund. The strength of idvo is its balance of growth and income. While cover call ETFs in general limit growth potential, idvo still manages to provide some nice appreciation, along with some income that's higher than your typical dividend fund. And the trade-off here is that you're giving up some of that upside potential for monthly income, since this is an income-focused fund first. So if you're an investor that wants international exposure and is prioritizing income over growth potential, then this is a fund to keep on your radar. Up at number 7, we have vymi, the Vanguard International High Dividend Yield ETF. This fund tracks the FTSE All World ex-US Index, which invests in international stocks with above average dividend yields. It invests in large and mid-cap stocks across developed and emerging markets outside of the US. And it filters out real estate investment trusts or REITs and companies that haven't paid a dividend in the last 12 months and aren't expected to pay a dividend in the next 12 months. Then it chooses the top half of those dividend-paying companies, which allows it to hold stable companies and avoid high-yield traps. Currently, vymi has 1,597 holdings in its portfolio, and it holds names like Novartis, HSBC, Roche, Shell, Nestle, and Toyota. On the sector side, financials makes up the majority, close to half, followed by energy, consumer staples, and healthcare, which is a diverse mix with some defensiveness built into it. vymi has an expense ratio of 0.07%, which is nice and low, and it has a dividend yield that's sitting at 3.4%, which is paid quarterly. And this fund has had some pretty solid performance with a 1-year return of 31.3%, a 5-year annual return of 13%, and annual returns of over 10% over the past 10 years. vymi gives you a nice combination of a nice dividend yield, diversification, and good returns at a low fee. And the quality dividend companies that it selects not only gives you balance, but also provides consistent income. Now, since its ETF focuses on yield, it's going to lean more towards value and away from growth. It's not the end of the world, but just something to be aware of. And if you're looking for a dividend fund that offers diverse international exposure and solid dividend payers, then vymi is a great fund to look into. And if you're looking for more options to diversify your portfolio, I talk about the 7 best value ETFs to buy in this video here, or you can check out this video here where I go into the 6 best ETFs for huge growth. Thank you for watching, and be sure to like and subscribe for more content, and I'll be seeing you soon.